We already put our pricing action in play. This is part of our third quarter results. We haven't seen impact on consumer behavior, in consumer demand.
I think we'll see that the cryptocurrency development or the cryptocurrency ecosystem will be regulated pretty much in the same direction as we've seen it from the classical world, and that means also for the future side of that one.
Good innovation is not afraid of regulation, but is afraid of being subjected to yesterday's way to regulate.
This is Bloomberg Surveillance, Early Edition with Francine Lacqua.
Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London, and here's what's coming up on today's program. Evergrande pulls back from the brink of default. The embattled developer avoids default with a last-minute bond interest payment. Inflation fears weigh on the market. U.S. 5-year break-evens hit a multi-year high. U.K. 10-year break-evens follow suit. Investors step up rate hike bets. Plus, Snap warns about supply chain holdups. The crunch also hits the digital economy. We'll bring you the latest on U.S. pre-market action. Now, first of all, let's check on the markets. And of course, there's a little bit of, well, when you look at the U.S. futures, I have to say they're going different ways depending on what you're looking at. A bit of support overall for these European stock 600, gaining some 0.3%. The focus is on the fact that it's a third week in a row globally where stocks are rising. The positive news came from China, with Evergrande actually avoiding a default with a coupon payment expected on Saturday. So just about within that 30-day limit. You can see the DAX, gaining. If you look at the S&P futures, a little bit more of a subdued picture. It's one of inflation. So we look at the U.S. 10-year yield. You can see there 167.48. It's all about inflation expectations. The other story, of course, it's what's happening in technology stocks. So let's look at the European map to look at the individual countries and give a difference of flavor of what we're seeing, for example, in the DAX gained some 0.2%. The CAC 40, one of the biggest gainers, and our Tom Mackenzie was telling us this, is L'Oréal. So they're saying they're seeing extensive sales because the markets or people are going back to work, the economy is reopening, and so people are buying more makeup, one of the biggest gainers in the CAC 40. So the global supply chain crunch that is affecting everything from chips to ships is also hitting digital services. And as winter approaches, these shortages are threatening the holiday season. Well, we spoke with a number of
It's really a matter of both chips and ships. We have a shortage of e-components, and we see the delays in the shipping industry and the congestions in the ports that probably intensified during the quarter.
Discussion has kind of shifted from commodities alone to energy and also labor. Energy, we feel it mostly in our trucking and shipping costs.
The bottleneck at the moment is transportation logistics. There are many countries in the world where procuring truck drivers is becoming the most important element of our supply chain.
When it comes to the supply chain, I think single supplies are probably not the future. You will always be looking for suppliers in the nearby where the factories and where we are operating, as well as having multiple suppliers.
We see the same type of supply disturbances posing some threats to the fourth quarter, but I would still not exaggerate.
Ultimate measure is, are our brands available on shelf the way that they're meant to be? And right now in our top 10 markets, we've got 96% on-shelf availability for our products.
And it's not that we did not have supply chain issues, but we were able to work through them. We anticipated short supply and longer lead times, and factored that into our planning with very specific mitigating actions.
Well, joining us now to talk about supply chains, inflation, and the markets is our markets editor, Christina Aquino. Christina, as always, thank you so much for joining us. I mean, Snap is a social company. Snap lost a quarter of its value, basically like that, by snapping the finger because of supply chain issues. I mean, no one's immune.
Absolutely, Francine. I mean, that was probably the biggest surprise yesterday into the U.S. session, right? It's like you say, no one is immune. And who would have thought that a social media company of all companies would have been affected by supply chain issues? But, reading through some of the PMI reports this morning, you start to understand why, right? We've heard from European businesses talking about all of these supply chain issues and all the higher costs that they're facing, the fact that they're going to have to cancel some orders or they're going to have to limit what they actually produce. And you start to understand why the advertisers, the businesses that keep the advertising revenue flowing for a company like Snap is suddenly flowing dry.
And Christine, I guess, I mean, the million-dollar question, which is why it's so difficult to see inflation, is a lot of this inflation or price increases or supply chain issues is because as the economy reopens, people want more. They buy more. We see it with L'Oréal. And we don't know whether then it stabilizes or actually this continues, these pressures and inflationary pressures continue to increase.
Absolutely, Francine. And I think that is what's fueling the transitory versus not transitory debate, right? I think it is, you're absolutely right. It's a recalibration of demand after the pandemic era. People are coming out of lockdowns, wanting to spend their pent up cash that they saved over the pandemic. And yeah, it's really wreaking havoc, shall we say, in the global economy because right now we're still in flux. We haven't reached that stabilization point where demand is kind of caught up to the bit of a pause that we saw during the crisis era levels. And so, yeah, I think that's what makes it difficult for businesses. That's what makes it difficult for policymakers, who are looking at this, because you could very well see once that stabilization of demand happens, then all these pressures go away. But at the moment, if you're talking to businesses on the ground, if you're talking to consumers on the ground, they don't care whether it's transitory or not. All they care about is that they're unable to fulfill orders as much as they would like. They're unable to afford some of the things that they used to be able to afford, or unable to get the special items, in their grocery shop because of these supply chain and inflation issues.
Yeah, and the Bank of England also, so we heard from the chief economist, and he's expecting inflation at someone at 5%. At the same time, it's uncertain whether they will hike rates in November or not.
Yes, absolutely. And I think, it's starting to become really a live meeting now. I mean, even earlier today, we're seeing kind of two conflicting signs in rates markets this morning, because we saw the 10-year inflation break-even rate, right? This is the market's gauge of inflation expectations rising to a 25-year high. But at the same time, we're also seeing pricing for the November rate hikes paring back a little bit. I think it was around 15 basis points, just a little bit less before I left the desk. And so that also tells you there's a little bit of jitters now as far as the November meeting is concerned, especially after Pill's comments overnight.
Evergrande, I mean, at least there's no default on our hands.
Yes, that is one last thing for markets to worry about, is Evergrande not defaulting on its payments. Definitely markets breathing a sigh of relief here. But I think, the story continues, right? I don't think markets are at that point where they're willing to kind of relax on this story at the moment, because, again, the investors, traders, everyone's still waiting for kind of broader signals from where China goes next in terms of its regulatory steps, where the economy is heading, because we are seeing early signs of a slowdown. And so, data, comments from the government, comments from the central bank, going to be really important here to give us a broader picture of how China is doing beyond just Evergrande in the property sector.
Christine, thank you so much. Christine Aquino there joining us on today's Top Markets. Now joining us is Edmund Xing, Chief Investment Officer at BNP Paribas Wealth Management. Ed, thank you, as always, for joining us. A lot going on in today's markets. It's Snap, it's supply chain issues, it's, of course, Evergrande. Where do you think the markets will get their cue?
Well, Francine, I think the first point to make is that we already are well through October, and let's not forget that the fourth quarter tends to be pretty good news for risk assets generally. So I think what we are looking for here is renewed surge in risk assets. Now, equities still seem to be pretty well positioned, commodities as well. So we look for those two asset classes to make further headway through the rest of this year. When I look at China, I think there is still, of course, a huge question mark. We have this huge internal debate ourselves. Do we recommend and try to bottom fish China and Chinese equities now? And I think the answer is so far not. While we like China for the long term, I think we're trying to resist the temptation to bottom fish right now, particularly in the tech stocks. And we think maybe the better approach in China is to look at Chinese domestic A shares, because this index has a lower tech weighting and is more exposed to the domestic push that we expect to come from the Chinese central bank. So I think that is going to be one key issue that we expect to emerge over the next few weeks.
Ed, overall, what do you do with technology shares? I think last time we spoke, you quite liked them. Yesterday, even Snap warned on some of the supply chain issues, and it wiped off a quarter of their value quite quickly. Does it make you hesitant on the Facebooks and Googles?
Yeah, I think, Francine, when you look at the fourth quarter, again, this tends to be a period when actually smaller cap stocks do well, mid and small caps. This segment of the market tends to be the outperformer over the fourth quarter. And if you were to look, for instance, at the Russell 2000 index in the US, you would see that it's pretty much gone nowhere. It's sat in a horizontal trading range for the last few months when the tech stocks, the mega cap stocks in the US have broken continual new highs. Now, we see a bit of a switch here. And I think what we see with this quarter's earnings and what we're going to see in this quarterly results is that companies that do not meet expectations are going to be heavily punished. And I think that risk sits squarely on the shoulders of some tech companies. You've seen, as you said, Snap, but I think the others as well may struggle to exceed expectations, because even exceeding expectations may be what they need to do just to maintain current share prices. So my money would be rather on rotation into the mid and small cap segment of the market, even in the US, over the next few months.
Ed, thanks so much. Edmund Ching, their Chief Investment Officer at BNP Paribas Wealth Management. He stays with us. Now, coming up, earnings season underway. Snap plunged post-market after third quarter sales missed. We discuss this and much, much more. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now we're back with Edmund Ching, Chief Investment Officer at BNP Paribas Wealth Management. Ed, thank you so much for sticking around. We talked a little bit about some of the industries that you were cautious about or that you liked. Overall, it does seem that markets are betting that inflation is here and actually is here to stay. And it could be hot enough to actually spur some monetary policy moves that the central banks have so far been quite reluctant to even flag. Does that reprice equities?
I mean, certainly it's a risk, but I don't think so, Francine, because I think the bottom line, if we think about particularly the Federal Reserve and to a lesser extent the ECB, I think central banks, we have to realize, are in a bind. They're in a difficult place. They do not have a lot of room for maneuver. Let's not forget that if you were to take the US government as an example, they sit on an enormous amount of debt on which they need to pay financing. If interest rates, particularly long-term bond yields, go up too far, then that will become too expensive. And that becomes a huge problem for the US government. So the Federal Reserve, even if they're going to taper, have to continue to support the US bond market ultimately, in my view. And that, even in the face of higher than expected inflation, remains the case, because they need to continue to cap the cost for the US government of financing and ultimately of refinancing their enormous debt load. And don't forget, the Democratic administration is still debating the potential for something like a $2 trillion supplementary spending package on infrastructure. And if that's passed, it will mean even more debt spending, which puts, I think, the Fed in an even more difficult position. Same is true to a lesser extent of other central banks around the world as well. So does it lead to a repricing of equities? I don't think so. I think actually a world where we have reasonably good growth, I mean, a bit slower than what we've had, but that's normal, plus a little bit more inflation than we've had in the past, is actually a fairly good cocktail for equities going forward, Francine. So as long as bond yields don't run out of control and people don't believe that the central banks have lost the plot, I think equities can actually do pretty well from here.
I mean, some people think the central banks have lost the plot, or certainly that they're behind the curve. Ed, what happens if actually there's a rate hike and then a rate cut quite quickly? I don't know whether this is one of the main dangers for the Bank of England and what that entails then for your appetite for UK assets.
Yeah, I think the Bank of England is in a particularly difficult place because not only are they dealing with the post-pandemic environment, but also they're dealing with the aftermath of Brexit, which is still having all sorts of consequences, with lorry drivers and goodness knows what else. So the Bank of England has a particularly difficult job at the moment, and we all know that similar to the US, the UK inflation historically has been very volatile. And so they probably do need to act, particularly to calm down a little bit of the housing market. Because again, remember, the Bank of England has a particular effect on the housing market. When they raise base rates, it will have an effect on mortgage rates and therefore on housing demand. Now, given the way that housing prices have risen in the UK, that's probably no bad thing if they tap gently on the brakes. Now, what does that mean for the UK economy? Well, I'm actually quite positive for the UK economy in the longer term. Obviously, in the shorter term, we know about the disruptions, but that's known, that's in the price. UK assets are incredibly cheap. I would actually be pretty tempted to be looking at UK assets, both on the fixed income and on the equity side, to be long these assets on a long-term basis over the next few years, because I do think they start to represent really quite extraordinary value.
Ed, give me a sense of what you do with Bitcoin right now. So I don't know whether suddenly it's a lot more mainstream because of that ETF that was quite bid, I would say, and some strategists now even seeing Bitcoin at $100,000 by the end of the year. Yeah,
I mean, from a wealth management point of view, you have to remember that most of our clients are very conservative and run very conservative portfolios. So an asset as volatile as Bitcoin or any crypto asset indeed is far too volatile for them, to be blunt. You might argue for very big portfolios, for ultra high net worth clients, it might merit a very small weighting, but even then, we certainly wouldn't recommend that. That is the client's prerogative. If the client really wants to do that, fine, but certainly it's not something we would ever recommend. It's very difficult with an asset as volatile as this to have a view and to put it in clients' portfolios. And I think that's where we are at the moment. However, I would say that looking broader at the sort of blockchain space and at tokenization, there, I think there is a lot of interest. And I think our view is always to play the picks and shovels approach to crypto assets and to look at blockchain technologies and the underlying companies that can benefit from the boom, for instance, in electronic payments that should result in associated sectors like cybersecurity as well.
Ed, thanks so much. Edmund Ching there, Chief Investment Officer at BNP Paribas Wealth Management. Now, coming up, Evergrande pulls itself back from the brink of default. We'll get the latest on China's problem child property developer next. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now let's get straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. The US and 5 European governments have resolved a dispute over digital taxes on American tech giants. The deal was reached after a broader global agreement to overhaul levies on big corporations. Under the deal, the European countries will retain so-called digital services taxes on companies like Amazon and Facebook. But once a global tax deal comes into effect, they will refund any levies in excess of the agreed rate. Now, the Federal Reserve will ban top officials from buying individual stocks and bonds, as well as limit active trading. The move follows an embarrassing scandal that led to Fed departures and clouded Chair Jerome Powell's path to re-nomination. Senior Fed officials will now be limited to purchasing. And actor Alec Baldwin has fired a prop gun on set that caused the death of cinematographer Helena Hutchinson and wounded the director. The incident happened on the set of the film Rust in New Mexico. The local sheriff's office said no one was arrested in the incident and no charges have been filed. A spokesperson for Baldwin said there was an accident involving a misfire of a prop gun with blanks. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Leanne, thank you so much. Now, Evergrande pulls itself back from the brink of default. That's after the developer paid a bond coupon just before the deadline. Now, for more, we're joined by Rebecca Chung-Wilkins, our China credit reporter in Hong Kong. Rebecca, thank you so much for joining us. What does this mean? Are they kicking the can down the road, or is it actually being dealt with?
I think it's probably the former. I think at this point it's unlikely that this is really a show of liquidity strength, but certainly is a definite sign that they're not keen for any kind of official default yet. And that's probably partly because an official default would allow other cross-default clauses to be triggered. It would allow bondholders to potentially accelerate their principles and move to even perhaps petition for bankruptcy filing, which of course could complicate Evergrande's asset sales. So certainly it looks like Evergrande and potentially also authorities are not keen or undecided still on quite how this is all going to transpire. But there are still quite a number of coupons, both on overdue that have already come and been expected, and on 4 more dollar bond coupons that are coming due through the rest of this year.
Rebecca, so what can we expect from the rest of the sector as a whole? Will it give it a little bit of a lift, or again, investors are going to be quite cautious going through this?
Well, we certainly have seen a bit of this relief rally today. So Chinese dollar bonds jumped this morning in Hong Kong. They look like they could be on track for their best performance in about a decade, which is really extraordinary given the kind of dramatic sell-off that we've seen, sort of some pickup in equities for property firms as well. So things certainly positive today, but I think overall the feeling is still that the general policy is to tighten things, and that a lot of these other weaker property firms will continue to face a lot of problems, particularly when it comes to refinancing all of these imminent debts. And while sort of Evergrande contagion in itself might be relatively well contained, folks are still looking for broader signs of contagion in the financial
Rebecca,
market,
thank you so much.
And of course in the economy.
Thank you so much, Rebecca Wilkins there on Evergrande. This is Bloomberg. Evergrande pulls back from the brink of default. The embattled developer avoids default with a last-minute bond interest payment. Inflation fears weigh on the market while U.S. 5-year break-evens hit a multi-year high. The UK 10-year break-evens follow suit. Investors step up rate hikes. Plus, Snap warns about supply chain holdups. The crunch also hits the digital economy. U.S. tech stocks sink in pre-market. Well, good morning, everyone, and happy Friday. Welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, there's quite a lot going on in the market. If you look at the European Stock 600, of course, the main focus, I feel like I've been saying that for about 3 months, is inflation. Watch for any price pressure, inflationary pressures. That could actually mean that although monetary policy or central banks are reluctant to change monetary policy, they could be forced to do. So if we have the markets, let's bring them up so we have a quick look at what we're dealing with overall. Again, the markets taking in their stride the fact that Evergrande is not defaulting because of that coupon payment. So stocks are rising, treasuries are gaining. I'm looking at Turkish lira. Not only could it touch 10 to $1, but we also heard from the head of emerging markets at Goldman Sachs that it could be even lower than that. And then overall, Bitcoin, it's had quite a week at 63,425. Let's also have a look at some of the technology stocks. Again, some of the things that we're talking for. First of all, there's this fabulous story on L'Oréal where consumer stocks are definitely leading the gains. L'Oréal up more than 6% after reporting a third quarter earnings beat, because guess what? A lot of people are going back to the office, which means that we're buying more makeup. This is as simple as that, maybe unexpected for some. And then Snap. This is a social media company saying that they're also struggling with supply chain issues. I think it took quite a lot of other technology analysts by surprise because they're social media and you don't automatically associate them with supply chain issues, down 21%. Now, job vacancies are at a record level in the US and the UK as businesses reorient for the post-pandemic world. At the same time, more than 5% of workers in America quit their jobs in the months of July and August, a record level of churn. So as both employers and staff search for something new, enter AllBright, a members club seeking to empower women in the workforce. Well, AllBright offers both digital and in-person spaces for women to reskill, to meet, and to collaborate. It offers around 170 courses and operates in more than 10 countries. Well, I'm very pleased to be joined now by the AllBright co-founder, Debbie Wosskow. Debbie, thank you so much. What a pleasure to be able to speak to you about important things. I want to, first of all, talk to you, how it's been. I mean, you run basically an event in person, right, physical place, and you've had to deal with the pandemic.
Well, it's been incredibly tough. If I rewind 18 months and look at the business that we had, or we thought we had 3 and soon to be 4 physical spaces that are women's only clubs, enlightened men, very welcome as our guests, that stood for something above and beyond bricks and mortar, and we're a physically led business. And we had a digital platform that was growing, that had about 40,000 women on the platform, that was there to try and replicate what the clubs were there to do, which is to help women to build their networks, to upskill, to build confidence and resilience, if you like, a new woman's network as opposed to the old boys' network. And of course, as with so many businesses that were physically led, we had to pivot in our business. It was the worst day of my career. when we had to shut all of our physical spaces 5 days before furlough had been introduced. So we thought we were consigning all of our team that we had built up over 2 years to be out of work.
Did you still have to pay for rent? Or did you get some relief on that?
It depended on the landlord. We had to go into battle. We had to go into battle, but also, to your point on L'Oreal and makeup, we had to become broadcasters. We had to reach out to our community. We had never used Instagram Live before, any of the platforms that we all became so familiar with, and we had to be there for our women globally. And we have been a huge success story. Our digital platform has 12x in terms of its size. We now have 500,000 women plus and growing in the AllBright community globally. And physical space is back, as we know, because nothing can replicate in real life connections. The organized serendipity that AllBright set out to build. But our business looks and feels different to the business that we thought that we were building a couple of years ago.
Debbie, what did you learn in the pandemic about what kind of networking women need? A lot of the brunt of child caring, caring for elderly, caring full stop, fell on the women during the pandemic and still to this day. What kind of support did your members need?
Yeah, let's be clear that the stats are not in our favour. We bear twice the mental load of men, not in every household, but most certainly in mine. And it's been very well documented about how women's careers were hardest hit by the pandemic, not least because women tend to be on 0 hours contracts more than men's. They tend to flexibly work, which was impacted. What our women needed to start with was a place to go and share and talk about how they were feeling. They needed network. We all need networks. The best thing that happens in our careers is because of the people that we meet. They needed to upskill, to reskill. They needed to learn how to become presenters, entrepreneurs. 2/3 of our community of 500,000 women want to start their own business as a result of the pandemic. I think that we've all felt a sense of a need for personal ownership. Right. I think we all had a bit of time to think, whoever has time to think, right, about who am I and what do I do and how do I want to work and what do I want to stand for and how do I want to make a difference. And we feel that women, when they're really harnessing their entrepreneurial potential, and that doesn't mean they need to go and start a startup. It might be that's changed the way that they think about working in their workspace is extremely powerful. And for that reason, our book, Believe, Build, Become, which is a woman's guide to supercharging their career, which came out just before the pandemic, is coming out again next week with some chapters reflecting on the pandemic, everything that we've learned, what we learned personally as founders, and what our community learned and needed.
And Debbie, there were some pretty horrific figures from this U.S. jobs report saying a lot of people have left the workforce, and I think even 3/4 of that are actually women.
Yeah.
Do you have stories like that? And what kind of advice do you give to business owners, to basically chief executives, to make sure that they don't lose the female talent if they want to keep it? Because they all say they want to keep it.
Yeah.
What do they have to do?
We have story after story, as you can imagine, because of what we do, of women who face a jobs crisis, either voluntarily or involuntarily. And I think this is a moment for employers to think about how they upskill, treat, and hire and retain their female talent. That's what the AllBright digital platform is there to do for employers. It's to help them to think differently about allowing women to build their networks outside of the workspace, about giving them the sort of support that they need, which is different, which has been different. So I think it's a positive moment in time for large employers and smaller employers, for SMEs, to think about women in a different way. But it's really important that the pandemic doesn't set women back.
Debbie, what's your top tip? So I know we have a lot of chief executives watching.
Okay.
Is there one thing that they should be focusing on?
Yes. They need to hire women, they need to listen to their women, and they need to ensure that their women have networks, that they allow them to upskill and to build their confidence and resilience. And they obviously need to buy the AllBright digital platform.
Of course. Always good to plug whatever you're doing. Debbie, if you look at a woman's career, just like a man's career, it starts in the 20s and then it goes, hopefully 60 and beyond. Is there critical years where you see women struggling more or needing more support, both from the government, I guess, if it's childcare, and their employers?
Look, women's careers are not linear. they're typically not linear. And I think if we can accept that as women, and if employers can understand that for women, that makes a real difference. The years of having small children are very hard on women, and we see in our AllBright community a brain drain at that time. But that is also the time when you are most likely to start a new business. That is the time when this point around agency ownership, doing it for yourself, what do I stand for, who am I, which is a lot of the thinking that we've done during the pandemic, is really powerful. But we need to be clear that female entrepreneurs do not get backed. Only 1% of all venture capital invested post the pandemic goes to back a female founder, down from a heady 2.17% pre the pandemic, right? Things are getting worse. We're not at the table. So my other message to the men listening to this who are chief executives or who are investors is back women. Yep. Women-led businesses deliver better returns than male-led businesses, and there are some amazing pandemic success stories, from Beauty Pie to Cult Beauty to Charlotte Tilbury to Spanx, as you saw yesterday. Back women.
And Bumble. Debbie, thank you so much for joining us today. Debbie Wosskow, their AllBright co-founder, joining us to discuss about, of course, her business and some of the important issues surrounding female participation in the workforce. Now, we're also getting some UK PMI numbers. This is for the month of October. It's been interesting to see the breakdown between France and Germany. And now we have the UK for the month of October. Manufacturing PMI, a bit better than expected. Services, also better than expected, actually. Services coming in at 58 instead of the 54.5 expected. A reminder, of course, everything above 50 means expansion. Now, Donald Trump uses a SPAC to bankroll a new social media company. The former president seeks to regain his presence online after he was kicked out of Twitter and Facebook. And of course, there's a SPAC angle. So we'll talk about that next. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now let's get straight to your Bloomberg Business Flash. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. Snap shares tumbled by as much as 27% after hours after lowering its earnings forecast for the fourth quarter. It's warning that changes to Apple's data collection rules and supply chain issues are weighing on advertising spending. The Snapchat owner is expecting revenue of as much as $1.2 billion in the final 3 months of the year, below analyst projections. Now, Intel fell after the close as the chipmaker gave a lackluster outlook for the current period. CEO Pat Gelsinger forecasts margins to be lower for the next 2 to 3 years and says they are spending to regain industry leadership. The company has also ended talks with chip designer Sci-Fi without reaching a deal, with sources telling us a startup will seek outside investment instead. And Renault will lose out on far more car production this year than previously anticipated due to the crippling global shortage of chips. This is another obstacle to the car maker's turnaround plans. The French manufacturer will make close to 500,000 fewer vehicles in 2021 due to a lack of components. Renault predicted a shortfall of roughly 200,000 back in July. And that's your Bloomberg Business Flash. Francine.
Thank you so much, Leanne. Now, Donald Trump uses a SPAC to fund a new social media company. The former president is seeking to reestablish his online presence after he was kicked out of Twitter and Facebook. Well, Trump's new enterprise is expected to be in operation by early next year. In the meantime, the SPAC it's due to merge with has been a big run-up in its share price. Well, let's get more with our Danny Berger, our Bloomberg Daybreak Europe anchor. Danny, I mean, this is an amazing story. I'm so happy that you're here to talk about it.
Yeah.
So first of all, what exactly is the pitch for the SPAC?
Yeah, it feels like everything was sort of culminating in this, considering we just have had this SPAC craze earlier in the year. So it's called Trump Media and Tech Group. The SPAC it's merging with, it's called Digital World Acquisition. There's not a ton we know about Trump's company specifically, because just sort of in the nature of SPACs, you don't have to give a lot of financial targets before merging. You don't have to lay out your business model. Instead, what we've seen is a slide deck from the company, basically positioning itself as, one, a social media company called Truth Social, so taking on Facebook and Twitter, and also maybe taking on Disney and Netflix as well. Those are also part of the slides there.
Yeah, so we don't really know if it's like more of an Instagram with photos or whether it's more like of a Twitter line, but there has been a lot of investor appetite from who?
Well, from the retail crowd, really, it is this YOLO crowd. I mean, it was incredible, Francine, to see yesterday this SPAC hasn't even merged yet, and it's up 350%. And kind of by the very nature of how this is structured, it's not for institutional investors. Usually SPACs have something called a PIPE investment. It's private interest, private investment rather in public equity. It means that you have institutions alongside the SPAC investing. This doesn't have this. This is very much so for the public. And obviously Trump has a very large online following, and people will buy it because they assume other Trump fans will buy it, kind of that Keynesian beauty contest. And this stock was mentioned a lot on sort of the usual suspects, the Reddit forums, the chat rooms. That really was a lot of the interest in this SPAC itself.
I mean, I don't know whether it actually spurs on more interest in SPACs in general.
Well, it certainly could, because it could indeed bring a whole new sort of investor base to the SPACs who haven't participated in SPACs before. I like what Matt Levine of Bloomberg Opinion says. He likens it to Elon Musk, that Elon Musk has such a big following, he can tweet about a cryptocurrency, people go in and they buy it. Trump can have the same effect as well of moving people to these investments because of his fan base.
Danny, thank you so much. Our Danny Berger, their Daybreak Europe anchor. Now, a sudden drop in the Fed's favorite Libor heir has Wall Street talking. Up next, it's time for Life After Libor. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now let's get back to the supply chain conversation, and it's good news for parents who haven't yet prepared for Christmas. Well, Mattel raised its full-year guidance after saying it has managed to work through supply bottlenecks, hobbling industries from car makers to social media platforms. Well, the owner of Fisher-Price, Barbie, and Hot Wheels is rising in pre-market. Its chief executive told us an increase in prices hasn't dampened demand.
It was another strong quarter for us with continued consumer demand for our products. And, we achieved growth and gained market share for 5 consecutive rows now. We do expect to continue growing for the balance of the year, gain market share, and have a strong holiday season. And it's not that we did not have supply chain issues, but we were able to work through them. We anticipated short supply and longer lead times, and factored that into our planning with very specific mitigating actions. And this is really where, our scale, expertise, and flexible supply chain model that we restructured over the last 3 years is playing to our advantage, and we are ready for a strong holiday season.
When you say you're going to have a strong holiday season, how much of the orders were front-loaded because people were scared about these supply chain issues? Are we going to see a little bit of a fade when it comes the fourth quarter and during the fourth quarter that we saw some front-loading already in the third quarter?
We are entering the fourth quarter with great momentum and off to a good start already. We're seeing that consumer demand continues to be strong. Retail orders are strong. Our retail promotional plans are in place. And, we have very exciting range of new product that we're introducing to the market. So, it's always hard to tell exactly about phasing of consumer behaviors. But we very much look forward to a happy holiday season with lots of toys for children to play with.
You did mention that you have managed to successfully reorganize your supply chains, but we've heard from numerous other companies that have had to pay over the odds for space on shipping containers, and getting things moved around has been costing a lot more. Are you having to burden any additional costs because of these issues?
Yes, we did see inflation. We talked about it before. We expected it. It is affecting our profitability. But even with that, we just raised our guidance for full year adjusted EBITDA to be between $900 and $925 million. It's the third raise this year. And we do expect to continue improve profitability and exceed $1 billion of adjusted EBITDA next year.
You mentioned inflation. How much of the price hikes of the materials prices is being passed to the consumers? Give us a sense of whether consumers will actually have to pay more for your toys.
Well, we already put our pricing action in play. This is part of our third quarter results. We haven't seen impact on consumer behavior, in consumer demand. And I can tell you is that when we raise prices, we always have the consumer in mind, and we always make sure that it is thoughtful, and we balance quality and value for consumers.
The Mattel chair and chief executive there, Ynon Kreiz, speaking to Bloomberg. Now, a sudden drop in the Federal Reserve's preferred replacement for dollar Libor is raising concern about potential auctions in the final stretch of the transition. Now, it's time for life after Libor. And here to discuss the decline in the secured overnight financing rate is Alex Harris. She joins us from New York. Alex, great to have you today on the program. Why should we care about this slump?
You know, as we hit the final stretch of the Libor transition, you know, the regulators have made it clear time and again that end users should be doing their due diligence, should be doing their homework on these alternative reference rates, and not just SOFR, which is supported by U.S. regulatory bodies here, you know, but also Ameribor and Bloomberg's BSBY. You know, these are issues that should be doing their homework. And so I think investors now, after seeing this drop, are saying, wait a minute, what's going on with SOFR? How is this actually calculated? And even though contracts are likely to be more tied to a SOFR average, these are still things that are important to ask because they will filter through. And clients, you know, and people need to know what they're getting into here in case, you know, they're investing in floating rate notes and those rates readjust. You know, this is the kind of risk and things people need to be diligent about.
So, Alex, what does this actually mean for the last phase of the transition?
You know, I think the transition is still on pace. I think there's, you know, the ARC, or the Alternative Reference Rates Committee, which is overseeing the U.S. Libor transition, is hosting a symposium next week just to continue for people to keep going, to keep, you know, doing their due diligence and to keep moving forward with this transition. Libor is still going away at the end of the year, where end users aren't going to be allowed to enter into new Libor contracts for 2022. You know, so you still have to keep going with it. But again, I think it's just a reminder that more broadly, you know, as you're looking at these different rates and figuring out, you know, as, you know, an issuer, as a borrower, what makes sense for you? You know, what makes sense for you and what kind of rate you want to use and what's your preference here? And that's really the reminder, is that it doesn't matter, you know, who's endorsing what, that you just, as an investor, you know, as a market participant, you have to do your due diligence here.
Alex, thank you so much. We'll get more, of course, on this Libor transition. Our reporter there in New York, Alex Harris. Now, of course, the Bloomberg Short-Term Bank Yield Index, or BSBY, administered by Bloomberg LP, the parent company of Bloomberg News. So we wanted to give you that as a disclaimer. Now, Bloomberg Surveillance Early Edition continues in the next hour. Anna Edwards will be in New York, Matt Miller out of Berlin, Kailey Leinz in New York. The focus, of course, will be on the UK inflation wagers. Again, it's repricing a lot of the gilt curve here in the UK. The focus also on Evergrande in China, and the fact that tomorrow we're expecting them to pay that coupon payment, therefore avoiding default. This is Bloomberg.
Inflation is definitely becoming more pervasive, more persistent than people had hoped.
Look around the world, like it's not just in the US we have inflation that is on the move. It's everywhere.
The path has become more uncertain lately. And we believe that kind of over that 5-year time horizon, it's going to remain uncertain.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards, Matt Miller, and Kailey Leinz.
It is 10 a.m. in London, 11 a.m. in Berlin, 5 a.m. in New York, and 5 p.m. in Hong Kong. On this Friday, October the 22nd, our top stories today. Global stocks are set for a third weekly advance, but Nasdaq futures fall as tech is dragged into supply chain concerns. Evergrande pulls back from the brink of default. The embattled developer is expected to make a last-minute bond payment before this weekend's deadline. And no ambiguity. President Joe Biden makes some of his strongest comments yet as the administration faces calls to clarify its stance on Taiwan. Very good morning from London, everybody. Kailey, really interesting to see European equity markets then certainly getting a sentiment boost from what we've heard from Evergrande and perhaps from the earnings story. We're thinking about inflation still, as our opening sequence made clear, but the tech sector in the US really moving to its own tune now.
Yeah, and all of these stories really are tied together, but because when we talk about the inflation issue, we're also talking about squeezed supply chains, and we have found out that tech companies are not actually immune to that. As for the picture in Asia, it was a more positive session for stocks. Most of the major benchmarks were higher. When it comes to currencies, they were stronger as well, but bonds, by and large, were selling off once again. Now, within Asian equities, it was China that actually had a bit of a margin of outperformance. Within those Hong Kong and Chinese stocks, one of your sector leaders was the Hang Seng Tech Index. It was up about 1.8%. And you also saw a broad sentiment lift from the fact that Evergrande did indeed make that last minute payment on its dollar bond coupon ahead of that grace period ending this weekend. So they are saved on that front for now, but they still have millions more in liabilities. So it's not entirely out of the woods yet. Nonetheless, you did see that stock up about 4.3%. To the downside, though, was coal. China, of course, trying to rein in those surging prices, and it is working. Coal futures down 28% in the last 3 days, 11.3% of that coming overnight. And then finally, I would note one of your underperformers in Asian FX is the Indonesian rupiah after travel restrictions were put into place to rein in COVID-19 cases. Right now, though, it's essentially flat against the US dollar. Now, here in the U.S., we are coming off of a record high for the S&P 500, the first record we have had since all the way back on September 2nd. This morning, though, futures are softer, and really those losses being led by technologies. Anna and I were just discussing NASDAQ 100 futures down about 1/3 of 1%. In the bond market, yields coming in a bit. We're below 170, 168.90 on the 10-year yield. Where the real action has been, though, is in the belly of the curve. That is where the repricing of Fed expectations is happening. The 5-year yield hit the lowest since February 2020 yesterday, and it's the break-even really making news because the break-even 5-year rate is at 2.92%. That is the highest going all the way back to when that maturity was reintroduced in 2004. Finally, just a check on Bitcoin to end the week. We are at $63,600. Yes, below the record high, but higher than we were yesterday, Matt.
Yeah, well, Bitcoin sold off hard yesterday. I looked at one point and it was down 5%. So not a lot of people coming in and buying that dip. Let's take a look at what's going on here in Europe. We do see green across the screen. You can see on the map here that most of the major indexes are gaining, with stronger gains in France and Germany than we see in Italy and Spain. For me, though, there are some really interesting corporate stories, starting with L'Oreal. It's pretty amazing that they did better than the street was anticipating with their third quarter earnings, and even an analyst who has a sell rating, a perpetual bear apparently on L'Oreal City, said they're really impressed with the company's ability to shift between regions when there are problems. For example, like now in China, L'Oreal has been quick on its feet and has impressed. There are a lot of sell ratings on this stock. I looked it up, 6 sell ratings, 10 buy ratings. Now, that is more than you'd typically see on a winner like this. It's gone from 50 to 400 in about 10 years. So L'Oreal has been an incredibly successful story. You can see the London Stock Exchange down. It's the biggest weight on the Stock 600 right now, and that is a supply chain issue, which I find fascinating as well. They've got these supply chain issues that are affecting, obviously, sales of consumer goods, tech companies, but to see it affect a stock exchange is really weird, and the reason is the LSE doesn't think it can upgrade its tech as quickly as it wants to because it can't get the chips that it needs. So to see the supply chain problem seep into other areas like exchanges, I find to be really fascinating. I just put HSBC here because they have earnings on Monday, so watch HSBC shares. And then finally, Volkswagen. Yesterday, Manager Magazine, which is a pretty reputable periodical here in Germany, said Volkswagen has hired a couple of investment banks, Goldman Sachs and Freshfields, to carry out an IPO of Porsche. We've been talking about this forever, but the stock has been lagging, and Herbert Diess, the CEO, really needs to do something. Apparently, the Porsche families are down to clown if they don't get their position in Volkswagen eroded at all. Bloomberg called Volkswagen. They didn't have any comment on the report, but the stock ripped yesterday, and it's up again today.
We know where your focus is then today, Matt. Yeah, really interesting on the LSE story, because that ties into what we're saying about US tech, about how US tech is now being hit by supply chains, which maybe not everybody saw coming. On L'Oreal, just wanted to add that the Bernstein analyst said that the performance of the company went from handsome to gorgeous, which I thought was very sectorially appropriate. Now, a look at what is ahead for us today. The second day of the EU Leaders Summit in Brussels will take place. Leaders must navigate tensions over both a climate change plan challenged by an energy crisis and also Poland's rule of law primacy ruling. There's a real tension there between the EU and Poland over the rule of law in that particular member state. Russia is expected to raise its interest rate at 6:30 a.m. New York time. This is after inflation hit a 5-year high last week. And at 11 a.m. New York time, Bloomberg's Francine Lacqua will chair a discussion about central bank policy in the wake of the pandemic. That discussion is a part of the South African Reserve Bank, the central bank, their centenary research conference, and it will feature Chair of the Federal Reserve, Jerome Powell. So do tune in for that. More on that later on this hour. Now, European leaders, as we said, gather for the second day of the Brussels summit. They have agreed on a common approach to deal with rising energy prices, although it fell short of calling for joint purchases or even joint procurement. For more, we're joined now by our European correspondent, Maria Tadeo. Maria, it does seem they've agreed something, but did they agree on everything when it comes to energy? They're all coming from very different places.
They're coming from very different places. We know that, Anna, the European energy market, it's incredibly complex and it's very fragmented. Every member state has a different energy mix. One would go from renewables, and they're very advanced on that front. Some are really struggling to move away from coal. So it does give you this idea that this is a very fragmented market. Not a single solution would fit all. Now, yesterday they did agree, however, on a common text. This took hours to negotiate. They agreed that they will look into the ETS system, whether or not there's speculation that's pushing up prices on that front. And they also said that every member state should use every measure that they can domestically to protect households. Now, the question here, of course, is that there was nothing on the wholesale price. There was very little on joint procurement. There was very little on joint purchases, and there was very little on joint storage. Remember, the French, the Italians, and the Spanish have said the best way to go about this crisis was to deal with it as an EU 27 bloc. You have more negotiating power when you negotiate as 27. But that clearly did not manifest in the text yesterday.
Poland occupied a big part of the conversation. How concerned is the bloc about a possible exit here?
Yes, and you know, Matt, this has been in the headlines for days now, whether or not we're going to see a Brexit, sort of like Brexit in Poland. Now, what I would say is that the two cases are very, very different. You know, Poland has always said they want to remain in the European Union. This is about the legality, and this is about the politics. Now, yesterday, I do want to stress the European leaders did have a discussion about this, but they were very polite. I was told it was very calm. It was seen as constructive. The Europeans do not want to antagonize Poland to the extent that it could antagonize the people. So what they say is that they want to separate the Polish people from the Polish government and keep that dialogue still very much on the table. Now, again, is Poland going to leave the European Union anytime soon? If you ask anyone today in Brussels, they'll tell you that is clearly not in the cards.
All right, Bloomberg's Maria Tadeo in Brussels for us. Thank you so much. Let's turn now to China, because Evergrande has pulled back from the brink of default by paying a bond coupon before this weekend's deadline. The move prompted a relief rally across markets in Asia. So let's get more on this with Bloomberg's Rebecca Chun-Wilkins. Rebecca, this is one coupon payment. What, at the end of the day, does it mean for the company and for investors in these assets?
Absolutely, it is just the one, and that's really important to remember, I think. We actually are facing a very similar type of deadline next Friday, October 29th, when we'll be coming to the end of a grace period for another dollar bond. I think, you know, ultimately Evergrande has sidestepped what would have been its first major public bond default, but it's not really a sign of improving liquidity, probably more a sign that Evergrande and perhaps also authorities aren't quite ready to get into an official default at this stage.
I'm just looking at a piece on China and Chinese risk, Rebecca. China markets begin turnaround after being priced for collapse. And that sort of underlines how this story spread out to become a broader story for financial markets in China. What does this mean then? This payment of this one coupon, what does it mean for the broader story?
Well, absolutely. I think we have seen a little bit of this kind of relief rally, and that's particularly concentrated in Chinese dollar junk bonds. You know, we've seen the best rally there, the best weekly rally since nearly a decade. I think the sort of fundamental question, though, is whether all of these gains are sustained, but also whether that ultimately improves and supports the financial health of developers. Many developers have been shut out of the offshore funding market since the crisis at Evergrande has kind of really spiraled. And until that they are able to start borrowing again, it's really going to be difficult for them to pay off all of their imminent maturing debts. And we may continue to see the sort of domino effect of default across that broader sector of property firms.
All right, Rebecca, thanks so much for joining us. Bloomberg's Rebecca Chung-Wilkins there talking to us about Evergrande and the problems out of China. Now, President Biden yesterday said the U.S. was committing to defending Taiwan, speaking of, from a Chinese attack. This was these were some of his strongest comments yet as his administration faces pressure to push back against Beijing. He spoke during a CNN town hall.
China, Russia, and the rest of the world knows we have the most powerful military in the history of the world. Don't worry about whether they're going to be more powerful. What you do have to worry about is whether or not they're going to engage in activities that will put them in a position where they may make a serious mistake.
All right, it sounds like a long-term setup for Admiral Stavridis' novel 2034. Emily Wilkins joins us out of Washington, D.C. Emily, how serious is this conflict?
Well, the White House says that Biden's comments last night don't reflect any sort of change in policy from where the U.S. has been previously. But I think it does speak to the larger the Biden administration and how they have viewed China and how they have viewed Beijing. You've seen President Biden throughout his presidency continue to make moves, sort of amping up the U.S.'s power with its allies, its power within the region of Asia and within the Indo-Pacific region. And I think this is sort of just the latest from President Biden, sort of making sure that he's asserting the U.S. power when it comes to dealing with Beijing.
All right, let's bring back to what he said domestically, because he was talking about the tax hikes that are part of his economic spending package. And he said he doesn't think there will be enough Democratic votes. And at the same time, we got reports overnight that Kyrsten Sinema, who's been one of the Democratic roadblocks, shall we say, in terms of that economic package, actually would support at least some tax hikes. Can you help us make sense of that?
Absolutely. So what President Biden was saying last night is more about the specific corporate tax rate. That's the one that Biden initially wanted to raise, and then Manchin said maybe we can raise it a little bit less. The White House was thinking that Senator Sinema would eventually come on raising the tax hike to some degree, but instead now they're looking at perhaps other ways to tax wealthy individuals and major corporations. It doesn't have to just be through the corporate tax hike. They're looking at a tax on stock buybacks. They're also looking at other potential ways to raise revenue. The big thing for Democrats here is that all these spending proposals that they're putting forward, the child care piece, the health care piece, the climate action piece, they have promised time and time again that this will all be paid for via taxes and via other revenue raisers. And so the real critical thing here for Democrats is at the end of the day is being able to tell the American people that all of their initiatives are paid for in some degree. And so if they don't have that raising of the corporate tax rate, can they find those revenue raisers somewhere else?
The sausage making continues. Thank you so much to Emily Wilkins of Bloomberg Government. And let's get back to the markets now and take a look at some stocks moving in pre-market trading here in the U.S. I have to begin with Snap because those shares are plunging about 20% before the bell after reporting after the bell yesterday. The big issue is the revenue guidance missed, and the company is blaming a few things for that. On the one hand, they say that Apple's new rules about user privacy are weighing on their ability to target advertisements. At the same time, they are also blaming supply chain issues because they say companies don't want to advertise products that they aren't actually going to be able to sell. So that stock is lower in early hours. It's a better supply chain story for Mattel, though. The toy maker saying it's actually been able to navigate those bottlenecks, and it is meeting demand. So it raised its full year guidance. That stock is up the better part of 5% in early hours. And then one more mover to the downside is Intel, of course, the world's largest chip maker. It wants to return to dominance. It's going to invest in its manufacturing to do so, but spending more means profitability is going to take a hit in the next few years. That's what the company said last night, and as a result, the stock is down more than 10% before the bell, Anna.
Yeah, absolutely. Looking at that share price then, that share price movement at Intel, 3 brokers downgrading their call on Intel as a result of concerns around those numbers. And some of them seem to be a bit divided on on what they think about that capital expenditure plan. Now, coming up on this program, we'll stick with the supply chain pain. Top executives from Mattel, we were just hearing about that from Kailey, to Union Pacific weigh in on the disruptions rippling across the globe. And the diverging fates of emerging market economies are on full display this week. We'll discuss with Phoenix Kalen, Societe Generale's head of emerging markets research. Lots to discuss. This is Bloomberg.
It's really a matter of both chips and ships. We have a shortage of e-components, and we see the delays in the shipping industry and the congestions in the ports that probably intensified during the quarter.
Discussion has kind of shifted from commodities alone to energy and also labor. Energy, we feel it mostly in our trucking and shipping costs.
The bottleneck at the moment is transportation logistics. There are many countries in the world where procuring truck drivers is becoming the most important element of our supply chain.
When it comes to the supply chain, I think single supplies are probably not the future. You will always be looking for suppliers in the nearby where the factories and where we are operating, as well as having multiple suppliers.
We see the same type of supply disturbances posing some threats to the fourth quarter, but I would still not exaggerate.
Ultimate measure is, are our brands available on shelf the way that they're meant to be? And right now in our top 10 markets, we've got 96% on-shelf availability for our products.
And it's not that we did not have supply chain issues, but we were able to work through them. We anticipated short supply and longer lead times, and factored that into our planning with very specific mitigating actions.
Top executives there assessing the impact of supply chain bottlenecks on their sales and outlook. Joining us now, Christine Aquino, who leads Bloomberg's markets coverage, part of the Markets Live team. Christine, very nice to be with you here in London. Let me ask you what you've taken away then from all of this commentary around supply chain, but also the data we've had out of Europe this morning. French manufacturing PMI, the steepest decline since lockdown. The German data may be losing a bit of momentum, but maybe it's a more complex picture than that.
Absolutely, Anna. I mean, I think, what we just heard from the CEOs very much being echoed by businesses on the ground in Europe. And this is very interesting because we're hearing about, the PMIs. This is a preliminary look at October, right? And so this is probably as good as you can get in terms of forward-looking indicator.
Very real time.
Absolutely. And businesses very much citing those supply chain issues as reasons behind them either having to downsize their orders or not being able to fulfill orders. And then also adding to the fact that higher costs as a result of all of this hampering their businesses. And so you really get a good look on the ground that matches what we're hearing from CEOs all over the world. It's all about, as one CEO put it, chips and chips. Very much so.
That's hard to say quickly. Matt.
Well, that's one of my favorite phrases. I don't know if Frans van Houten knew that he was coining a term that's going to be, I think, used to describe this period for a long time. It brings about inflation, and I guess the debate about transitory is near over, right? Because this is sticky.
Well, Matt, it depends who you ask, right? I mean, if you're asking businesses, if you're asking CEOs, if you're asking your regular consumer shopping at the grocery store, exactly. Central bankers still argue it's transitory, but a lot of people on the ground, whether businesses, CEOs, consumers, all think it's very much sticky. And that's really what they care about, right? The price of their food shop, the price of doing business. And all of them are kind of really believing that this is here to stay.
Central bankers in the UK may be acknowledging a little bit of that stickiness. Certainly the chief economist at the BOE talking about a finely balanced decision in November. Christine, thank you very much. Christine Aquino of Bloomberg Markets Live. And for more market analysis, check out MLIV Go on the terminal. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kailey Leinz in New York with Anna Edwards in London and Matt Miller in Berlin. Well, big news. We're told K-pop group BTS is ending its distribution deal with Sony Music's Columbia Records in favor of Universal Music. Universal has been pursuing the tie-up for years, with CEO Lucian Grainge personally wooing the founder of BTS's management company. Universal's Interscope has had a deal with K-pop girl group Blackpink for 3 years. I'm not that familiar with BTS, but I know your household is very much so, Anna.
Yeah, absolutely. I'm sure I'm supposed to say something very intelligent about cultural exports, but let's leave it there. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller in Berlin and Kailey Leinz in New York. And Matt, European equity markets, where we are doing quite nicely, thank you, making some modest gains. US futures flat to pretty negative, actually, on the NASDAQ. It seems that there's a big divide across the Atlantic this morning.
Yeah, well, also remember, yesterday at this time, European markets were doing terribly. Poorly, and the U.S. ended up in the green. At least the S&P 500 ended up at 45.49, as Kailey pointed out at the top of the program, an all-new high. So it seems we have different drivers. The earnings are really moving markets here, whereas in the U.S. it's a much more macro picture, I think, that's moving stocks.
Yeah, and certainly those tech themes. Kailey, you've got the latest on that.
Yeah, it's so interesting. The tech story is very different on both sides of the Atlantic, as you both were just referring to. Yes, the stock 600 is higher, but what's interesting is one of the sectors leading that charge is technology. The technology index is up about 1.4%, the broader index up about 0.5%. That is not the story here in the U.S., as you alluded to. Futures really down across the board, but it is NASDAQ 100 futures that are underperforming, down about 0.4%. That story largely due to the earnings we got out from Snap overnight. More on that in just a second. In the bond market, where I'm really focused is not at the longer end, but actually in the belly of the curve. The 5-year yield coming in just a touch today, but at 123.70, it is right around its highest since February of 2020. And of course, we've seen those 5-year break-evens really breaking out as well. And then finally, just a quick check on oil, heading for its 9th consecutive weekly gain. Right now, WTI crude trading at $82.85 a barrel. Back to that Snapchat story, though, of course, it missed revenue guidance after the bell yesterday. The stock is down 20%. It's showing that even social media companies are not immune to supply chain issues, because companies facing those challenges aren't going to advertise products that they actually can't provide and sell. So that is what Snapchat is saying, and that is weighing on other social media stocks that are really reliant on advertising for revenue as well. The likes of Facebook and Twitter, each down the better part of 4%, and Alphabet, which Google, of course, is very reliant on advertising, is down about 2% as well, Matt.
All right, very interesting moves indeed. The one thing tying the two tech areas together, which Anna was talking about at the top of the program, is that you've got problems with chip makers or chip equipment makers like Intel and ASML in terms of getting their own stuff. So the supply chain is even hitting those people who are screwing up the supply chain. Let's shift gears here to emerging markets. We have a shortage of a number of things, not just chips and ships, but also gas, especially in Europe. And that's put Russia in a really great place. If you take a look at the world currency ranked return screen on the Bloomberg terminal, you'll see that over the last year to date, Russia has been the best outperformer. The ruble has been the best performer against the dollar of all emerging market currencies. I don't think it's a huge surprise that the Turkish lira is the worst. We've all been watching that. Well, it's like a train wreck in slow motion in terms of the currency. But the ruble is interesting, especially since last week we heard, or maybe it was earlier this week, Russia said they're not going to give Europe any more gas unless it goes over the Nord Stream 2 pipeline. It's almost like Occupied is playing out in real life. Joining us now is Phoenix Kalen, Societe Generale, head of emerging markets research. Does Russia here really have the tiger by the toe, Phoenix?
Well, we are entering a pretty difficult period over the next couple of quarters with respect to energy prices and energy supply, with so many bottlenecks around the world, with China demand and Asia demand overall ramping up, European demand ramping up for the winter. We could have a difficult winter. So yes, in a sense, Russia does have some leverage on this point. I mean, there's there's of course going to be considerations around whether or not this is a political game, whether Russia is really putting the crank on Europe to try to fast track Nord Stream 2. I'm not sure if that's really the whole picture. I mean, Russia has been having its own supply issues. And so I think, of course, we are going to need for Nord Stream 2 to come online relatively soon. We think that will be fast tracked, and that could happen in the next couple of months. And that can, over the next couple of quarters, start to resolve some of the natural gas supply issues.
So how does this, energy inflation situation, as well as the supply chain woes, affect China? Because we saw the renminbi as the second best performer against the dollar, but they're not in the position that Russia is in terms of their oil reserves.
No, they certainly are not. But I think the renminbi has been kind of a counterintuitive performer in terms of how resilient it has been. I think that's been attributed to the current account surplus staying quite in positive territory, counter to kind of some of our expectations that exports would start to decline as the economy decelerates. I think that is probably going to materialize at a much slower pace than we imagined, partly because of those supply chain bottleneck issues. Vietnam won't be able to come back online for some time, and in the meantime, that will be a boost to exports for China still. So I think on that standpoint, it's going to be a protracted situation that we see playing out, with the renminbi possibly being more resilient as a safe haven currency in the region, and also benefiting from a continued current account surplus, benefiting from continued portfolio flows both into equities and bonds, and so overall it's still a stable currency, with the PBOC having a lot of muscle to control the stability of the currency going to next year.
Yes, and how imminent do you think any kind of cut in the RRR is, Phoenix? This has been something talked about for a little while, and we've seen some measures from China on monetary policy, but a lot of people still talking about the need to do more as the real estate market stalls, or at least parts of it. What are you expecting on RRR?
Yeah, we are expecting for them to come out soon. We are also expecting for them to cut policy rates, maybe 10 basis points as a start. We do think that they have to do a multi-pronged approach to try to cushion this deceleration that we're seeing in the economy. We want them to kind of step up and kind of make sure that there are no disorderly defaults by the large developers in China. Of course, we think they also have to lessen the restrictions that they are putting in place in mortgage lending and property purchases to try to cushion that fall on housing sales. And then, fiscal support, targeting consumption, and then the monetary support targeting RRR and policy rates as well. So all of these measures we think are needed to try to cushion this deceleration that's happening in China, which is reverberating across the world.
Phoenix, you started the conversation with Matt talking about Russia, and I want to go back to the direction of Russia and Central and Eastern Europe. How much do you think COVID fighting and lockdown measures, or at least societal control measures to tackle COVID, how much are they going to be something that we'll end up trading around as we go through the winter? I see that there are some areas of Central and Eastern Europe where lockdowns are maybe expected or maybe not so severe, but at least measures may be reintroduced. Is that something that markets are going to trade on once again?
Yeah, I think that is definitely a big theme that's playing out, especially in the Central Eastern European region. We're seeing a rise in COVID cases, a rise in infections, a rise in death rates across CE4 countries. And then that does introduce the possibility that policymakers might be a bit more restrained in their hiking sentiment over the coming quarters. So that might limit maybe the pace of currency appreciation in those countries.
Phoenix, I want to ask you about Turkey, because of course we got that 200 basis point rate cut yesterday, even though they're faced with 19.5% inflation. I was actually moderating a panel on Turkey yesterday and asked an EM strategist, what would it take for you to become more positive on Turkish assets? And he said a 500 basis point rate hike, and that's pretty much it. What's your take on whether or not Turkey is actually investable right now?
Turkey is really not the place to put your money in right now, not for bondholders, not for equity holders. We've seen continued outflows from both of those markets over recent weeks, and understandably so. I mean, even if we saw a 500 basis point hike, that would bring us back up to roughly where inflation is going to come in the next couple of months. So we'll be seeing basically flat, zero real positive policy rates. And that's not an attractive environment, given the politics involved, given the continued political pressure on the central bank. I don't think a 500 basis points is going to do it. So for me, I think it will be kind of a much more dramatic change that's needed.
Yeah, and a 500 basis point rate hike is probably unlikely, given President Erdogan has called himself an enemy of high interest rates. Of course, the Turkish lira is at a record low against the U.S. dollar, but the dollar also broadly is just a lot stronger in 2021 than was the consensus coming in. Given that story and higher Treasury yields, how hard is it for EM assets right now?
Yeah, I think the room for maneuver is really narrowing. We've got growth slowing down. We've got inflation ramping up. We've got central banks reverting to more and more aggressive rate hikes, which is, of course, going to stymie growth and the recovery from the pandemic. We've got, of course, vaccination rates still low in many parts of EM. These are all factors that are going to compound the situation going into next year. So I think the pressures are going to be on both sides, on both currencies, as well as upward pressure on bond yields and rates.
Phoenix, thanks so much for your time. Really good to speak to you. Phoenix Kalen, Societe Generale's head of emerging markets research. Thanks for spending time with us here on Bloomberg TV. Coming up, Snap warns about supply chain hold-ups, and this is new. The crunch also hitting then the digital economy. We'll discuss next. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. You're looking live at the principal room. Coming up later today, the CEO of Chipotle, Brian Niccol. That's at 3 p.m. in New York, 8 p.m. in London. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Kailey Leinz in New York with Anna Edwards in London and Matt Miller in Berlin. Well, Snap shares are continuing to tumble in pre-market trading. That's after the company lowered its earnings forecast for the fourth quarter. It's warning that changes to Apple's data collection rules and supply chain issues are weighing on advertising spending. For more on that, let's bring in Bloomberg's Tom Mackenzie, who joins us now from London. So, Tom, you wouldn't necessarily put social media and supply chain issues together, but that's what Snap is saying. How poorly does that bode for some of its competitors?
Yeah, absolutely. That's where we're at now. You're looking at potentially a $25 billion hit to their market cap. If you take into account the impact on their competitors as well, the likes of Twitter, Facebook and Alphabet, you could be looking at a drop of about $100 billion in terms of the market cap across that tech space. So it is significant. You're absolutely right. This was the big surprise. Supply chains, not just hitting those traditional companies, but also social media as well now. They're saying that simply their advertisers can't advertise if they don't have anything to put on the shelves and don't sell and can't sell. There was also the data component. So Apple changing up the data restrictions on their phones on iOS, which means when you have an app and you have to sign up, you have to agree to have access to your data. Only 25% of people do that. So that means that it's making it more difficult for those advertisers on Snap to tailor their ads to their customers. So this is the impact. They're forecasting, by the way, earnings for the final quarter 50% lower, almost 50% lower than the estimates. RBC coming out saying management on the call could not have sounded worse.
Oh, wow. Well, that's pretty damning, isn't it? I mean, interesting to think about where the supply chain crisis hits next then, because it's hitting social media. We didn't necessarily expect that. Hitting Intel as well, in the sense that chip makers are also having to deal with their own supply issues whilst they're also, you know, not managing to deliver enough chips for everybody. We've got markets, though, investors divided on the capital expenditure plans over at Intel. What did you take away?
Well, Intel should have been positioned to take advantage of that demand for semiconductors, but it's lost its edge. It's lost its edge to the likes of TSMC over in Taiwan. You've got some of its major clients, the likes of Amazon, Apple, of course, building out their own chipsets in-house. So they're trying to reposition. Pat Gelsinger, who took over as CEO and came back to the company in February, saying, we're going to reposition. We want to be the market leader. But by the way, it's going to come with a cost. And that came through in this earnings call. They now are looking at spending $28 billion just next year alone. And in terms of the fourth quarter forecasts from Intel, they're projecting a decline in terms of sales of 3%. 10%. But earnings per share, this is the forecast, down 40% for the fourth quarter as they spend heavily to try and catch up.
And when you work in the chip sector and the whole world is waiting for chips, you'd think that maybe the market would look favourably on a plan to invest to enable everybody to get more chips. But that doesn't seem to be the case.
It's about the time frame, isn't it? Have they already lost that market share? Has that been held? Is it going to be held by the likes of TSMC and Samsung? And to what extent are their clients going to migrate away from them and continue to build out their own chip capabilities in the longer term? Has Intel left it too late?
Are we hearing anybody forecast the end of the supply chain crisis? I mean, I know yesterday we heard from Unilever that it could peak in the first half, but still continue on for at least 12 months.
We're not hearing anyone that we've spoken to saying that it's going to stop anytime soon. 12 months to 18 months seems to be something the consensus from the guests we've been speaking to. But it's really interesting, Matt, isn't it, that those companies, the big blue chips, seem to be weathering this better than others when it comes to that power of passing on the pricing. We saw that, as you say, from Unilever, but also L'Oreal gaining very strongly in the European session today. And you had Bernstein coming out and saying, look, this company has gone from handsome to gorgeous. They say that L'Oreal can absorb these cost pressures and the supply chain constraints. They can pass on the prices, and they are in position to weather this storm. In the tech space, though, the supply chain constraints around semiconductors very much expected to continue into the short to medium term, at least.
Yeah, very nice line from Bernstein.
Yes.
I know you told me that earlier. Right, Tom Mackenzie, Bloomberg's Tom Mackenzie with the latest on all of that tech news developing overnight. Now, coming up at 11 a.m. New York time, Bloomberg's Francine Lacqua will chair a discussion about central bank policy in the wake of the pandemic. The discussion will feature Fed Chair Jerome Powell. We'll get a preview with Francine next. This is Bloomberg.
Inflation is definitely becoming more pervasive, more persistent than people had hoped. And I think that's happening for a couple of reasons. One is money supply has grown really significantly by more than a third since COVID, which happened monetary fiscal response to the crisis, but it puts more money in the system. And then at the same time, we have some big structural shortages.
Blackstone President Jonathan Gray weighing in on the inflation debate as the debate rages on. Later on today at 11 a.m. New York time, Bloomberg's Francine Lacqua will moderate a discussion about central bank policy in the wake of the pandemic. The discussion will feature Fed Chair Jerome Powell, Bank of International Settlements, the BIS General Manager Augustin Carstens, and also the South African Reserve Bank Governor Lesetja Kganyago. So an all-star lineup, and Francine joins us now talking of all-stars. Thanks very much, Francine, for coming to talk to us about your panel that you're hosting a little bit later. Big questions then about how central banks have dealt with the pandemic and how they are changed by it on the other side. What are you hoping to address?
So we're basically breaking it down in four main themes, Anna. So first of all, we look at inflation, monetary policy, the outlook, of course, after the pandemic, and how it changes our kind of societies. But really, it's all about monetary policy and how they normalize if inflation surprises on the upside. So it's very clear if you hear from the ECB. So let's leave the Bank of England on one side. But certainly the Fed says this inflation is transitory. Yes, we're seeing inflation. It could be quite elevated, but actually what comes after is some kind of normalization mid-2022. If they're wrong, and we talk about it here every day, what happens? Do they have to hike rates quite abruptly? Does it shake the markets even more? Because that's what the markets are pricing in right now. So it'll be an interesting conversation, and to see the three of them interact, because they'll have different points of view. One thing that Bill Dudley actually wrote about extensively is the fact that because of the framework that the Fed has put on itself in the last 2 years, it's very difficult for them to see the normalization needed in monetary policy because of their focus on the labor market.
Okay, and that's interesting because we have seen a bit of an evolution in central bank thinking, haven't we, in recent years, where it was very much all about inflation previously. And then even before the pandemic, there were questions about how much the central banks need to take on board climate change. And now we add into that sort of social inequality themes. And then you have some voices on the left saying they need to do more on that agenda. Others on the left saying, hang on there, or in the middle maybe in US politics in particular, saying this is all a bit too woke. It's a really interesting question, isn't it? Just how much central banks move away from the inflation-fighting mandate and try and address these other areas. And they have different mandates.
Absolutely. Yeah, but if you look at inflation, it's even difficult to try and understand whether this is transitory or not. So there's a couple of things when you speak to chief executives that they'll tell you. For example, the Unilever chief executive says, look, there's going to be price pressure. He hasn't seen this kind of price pressure for the last 2 decades. And he says, we're going to see it for the next 12 months. Is this because we suspended the economy? And a little bit like L'Oréal, I know Matt Miller was very interested in L'Oréal. You know, people are buying makeup because they're going back to work. So is it just a kind of, you know, going back to a more normal life, and so we're shopping and buying more? Or is it really inflation that is entrenched because we're expecting more inflation, so we want to buy things now?
Yeah, I don't wear much makeup, with the exception of a period in high school when I was listening to The Cure a lot and flirting with eyeliner. You know what? I'm really interested.
No one believes.
I'm really interested, Francine, to hear about the crypto views of the gentleman that you're going to interview, because central banks at some point, Mike McGlone tells us from Bloomberg Intelligence, have to either adapt digital currencies or lose out, right?
Yeah, and this is one of course, the themes that we heard Christine Lagarde on. The Fed also looking into this digital bank, but it's a little bit different from the crypto. And if you also speak to, for example, the Bank of England, who's done a huge, rise in trying to figure out what this becomes, it's basically, are we going to become a cashless society? And what that means in terms of risks if we put it online. It's very different from the ether of the Bitcoin, which for the moment central banks are worried about because they say it's just speculation, too much volatility. And so they worry, for example, if there's a mom and pop's retailer that buys into it, what it means for financial stability overarching. But of course, it's one of the things that probably we'll touch on. We have an hour and 15 minutes with them.
Yeah, they certainly want to talk about their own digital currency efforts, don't they? And regulating some of the other ones out there. The private money thing, not sure they're quite so down with. Francine, thank you very much for bringing us a preview of your panel, and it'll be a really interesting one to watch. So stay tuned for that here on Bloomberg. Full coverage of that panel starting at 11 a.m. New York time. Now, a look at what we are watching. Why don't you go first this morning, Matt Miller?
Well, first of all, I want to point out, I'll be on radio at 11 a.m. with Paul Sweeney, New York time, and I hope that we're going to take a substantial portion of Francine's panel, because I'm really looking forward to that.
And watching the headlines from it.
For sure, and reporting those. On a completely different note, what I'm watching involves motorcycles, may be a surprise to you. Ducati's CEO yesterday, Claudio Domenicali, came out and said the Bologna Bullets are going to be making electric motorcycles for the MotoGP's Moto E Series, which is fascinating to me because previously Ducati had been kind of hemming and hawing on the fence about electric powertrains for motorcycles. Also, this weekend, the race is back in Misano, so in Ducati's backyard in the Motor Valley, and I'll be watching very closely. Hopefully they win.
Okay, I wonder if you need to go test drive some of these e-bikes. That's the wrong word, isn't it? But electric motorcycles. I'm going to be watching the Russia 8 decision. We spoke to our guest, Phoenix, Matt, about this a little bit earlier on, and there's a lot of focus on this. Will it be 25 basis points? SocGen says it'll be 50, and there are other voices out there in the market saying, yeah, 50 is really possible. It's a really interesting era in central banking, isn't it? These meetings are now live. My colleague Mark Cudmore was saying to me earlier on, it's exciting. These markets are live. We're getting two-way conversations. Certainly that's the narrative here in the UK around the Bank of England. So lots more to look ahead to when it comes to those central banking decisions. More Bloomberg surveillance is right ahead. This is Bloomberg.